You gotta be careful what you wish for. On Saturday's update, we had talked about a pullback to start the year, and so far, our wish is the market's command. Perhaps a pullback, though, we don't want to buy just yet, as the risk-on indications are deteriorating, and they're doing so rapidly. So let's take a look and finish up the first week of 2024, which so far looks like it may not end on a pretty note. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. Let's begin with a zoomed-in look on the SPY daily time frame chart. Of course, to assess trend first, we understand that we're sitting on an equal low, and we are pulling back, of course, from the highest high. So unfortunately, bears, you don't technically have a daily downtrend yet. I would argue the trend is neutral, but it does look more likely than not we will flip into a daily downtrend. And my reasoning behind this is twofold. Number one is that on the Tuesday session, we produced a perfect gap fill reversal, not only off of the Friday low, but as we know, this inflection point here, 473.75, is where the sellers would have felt emboldened. We know it was the breakdown area from here and on the Friday session from 2 weeks ago, and not for nothing, when you turn prior support, Friday's low, into newfound resistance, Tuesday's high, that of course is an early indication that yes, things are changing and not for the bull side of the market, certainly getting more bearish, right? The next thing to point out is that technically speaking, Tuesday could have offered a daily higher low. You have a hammer-esque style bar, and what would have been required is a break of Tuesday's high to trade back to the equal high. Then of course it's game on for the all-time high as a target. Obviously that did not take place. On this Wednesday morning open, we opened weak towards the lows of Tuesday's range, and the candle speaks for itself. It closed extremely weak down towards the lows, an equal low on the daily time frame chart, and at the bottom of our daily balance range. So the risk here is that we've completed the look above and fail, right? Technically, if this is a balance range, this is a failed break to the upside. We failed back down into the range, and we always target the bottom end of the range. That target has been fulfilled. So if the market's looking for a new setup, there's really 2 things that can take place here to kick off a strong daily downtrend. Number one is that we now have a 100% retracement of this move right here. If it requires a lower high to move forward, obviously any lower high is on the table as long as it's underneath that inflection point at 473.75. And not for nothing, but that of course starts to suggest a very classic head and shoulders. Underneath the neckline here, 468.50, and we are off to the races in a daily downtrend. So we can rally, short-term rally. I'm not talking about a major reversal to the all-time highs. I'm talking about a very short-term 1 or 2 day rally to produce a lower high anywhere underneath 473.75, and that would remain bearish for our market, setting a lower high from here to here. Obviously, situation number 2 is that we just get straight up follow through to the downside, automatically bring in some sort of lower low. That kicks off a daily downtrend, and you can either opt in for continuation here, or the conservative trader says, okay, if this is going to turn into overhead supply, any lower high reattempts underneath 468.50 are tradable in the downward direction. Tight risk reward, stop goes over the top, enter somewhere close to here. And this, of course, is an intermediate target at 465 down to 464.25. That's the FOMC origin. But really, when we look left, this is a thin structure breakout in the upward direction. The next major area that we want to be thinking about is way down below at 459. And what do we know about 459? That technically would be a weekly higher low. So when and if we get down here, I'd put my thinking cap on and say, okay, we've been vertical for 9 weeks in a row, no weekly pullback. If we get a weekly pullback, I would say, all right, how many buyers want to step up? How many people want to participate in the upward direction? How many people missed the move, had FOMO, and are looking for a decent entry price? 459 would be that first offering. So again, when and if we make it down there, I would start looking for potential daily reversals, something that would be a daily double bottom down here, something that would be a daily inverted head and shoulders down here, or just a very simple hammer candle that gives us some way to manage our risk up against that level. Again, 459 is the key number. Before we move on down to the hourly chart, we have not looked at this study set in quite some time, and it serves as a decent reminder when we're talking about weekly higher lows, right? These are the anchored view apps anchored to every major inflection point when we were pulling back through the duration of the autumn time frame. Notice that the major cluster is far underneath 459. It speaks to, sure, you could get some short-term profit taking up here, but as long as you're over this area, technically speaking, buyers are still feeling decent about any positions that were initiated during this pullback over here, about the midpoint or even last quarter of last year's range, if you will. So for the most part, that does strike me as a bullish supporting piece of evidence for 459 acting as a potential weekly inflection point for a higher low. This feels good on the higher timeframes, knowing that we're above all of the anchored view apps. The last thing I'll do here is just punch in a little bit back to our daily, and we will zoom in a little bit here. We want to take a look at the Fibonacci retracement from the beginning of this rally. Remember that the first higher low, I know it's slightly off screen here, but this was a godforsaken range, almost 2.0. Remember that we had the summertime godforsaken range, and this was almost 2.0 over here. When we got the first higher low, this kind of kicks off the rally in the upward direction. So we're using a Fibonacci from the low of this Thursday session here to the most recent high. And what you'll notice is that we're tangled around the 38.2. It's not clean for all intents and purposes, around 468.50, but it's in this neighborhood. So if the market were to see a rebound off of this and really go more sideways and then recapture 473.75, I would have to give the buyers the benefit of the doubt and say that this is nothing more than weekly bull flag consolidation. Yes, it would sort of go against the thesis we've outlined so far, but this is the only time in which we're doing something like that. You need a higher low over 473.75 if we're going to change our tone on the daily time frame chart. Outside of that, I would say in the short term, this, of course, is a big risk to turn into overhead supply, lower high inside of range, break down lower high here. This is kind of the outlook that I would have as we walk forward in the short term for our market. I'm willing to change my tone if we get a higher low above 473.75. Let's get more granular on the hourly. So you can clearly see that we're, of course, in an hourly downtrend now with consecutive lower highs as well as lower lows. And at the end of today's session, we've almost just concluded an equal low in the trend sequence. So therefore, the door is open for a breakdown here. We've already produced the intraday lower high up against 471.50 and seen a full retracement of that back down towards the lows. So again, the door is open here. You don't really need any major lower high that's set. The daily chart is not necessarily overextended. Sure, we're through the lower bound of this week's expected move, but remember, markets move from balance to excess and then excess back to balance. We had preceding excess to the left of the screen here. This is certainly a period of balance. And if this is a failed breakout, there's nothing saying that all of this acting as overhead supply can't continue to fuel a market move in the downward direction. So I'm not really concerned with the lower bound of this week's expected move there. It doesn't strike me as like, oh my God, the market's overextended. Not really. We're just in a very firm downtrend. And I want to highlight again the importance of Tuesday's failure. We already know about the gap fill reversal. We know why this level is so important, but even look at the close of day on Tuesday, right? There's really sharp reversal back in the upward direction, but it begs the question, is this market on close imbalance just a mechanic of the market for the first trading day of 2024, or are these stronger buyers? If we had stronger buyers, you could have imagined an open inside of this range here, basically above 471.50, keeping the daily higher low thesis intact. Maybe this would have turned into some sort of inverted head and shoulders. We're of course speculating as of right now, but this is what a stronger bullish market would have done if that move was true into the end of Tuesday's session. Because we opened up weak, because we produced a big time lower low, because we clearly rejected for a lower high underneath the morning pullback low, I would tend to think that, okay, this end of day move on Tuesday, it was nothing more than just positioning on the first of the year. So the bears retain control of the hourly time frame chart. If we are going to see a reversal on the hourly chart for a daily lower high up against or anywhere underneath 473.75, I could envision this maybe turning into a double bottom. It would really require a sharp move soon on the Thursday session, then a higher low over that neckline, and maybe we could trade bullish from here to here, but then promptly change our tone at 473.75, looking for that daily lower high up against the area. So there's a short-term scalp in the upward direction there, and if you're quick draw McGraw, maybe you could get it off the bottom end of the range here with a stop here, right? Your first target is the neckline, then looking for follow through. If you can spot that trade, there's nothing wrong with that as long as you're managing your risk almost directly underneath 468.50. The concern on the hourly chart, of course, as we just pointed out, is that we basically produced the lower high H pattern equal low. If we just get straight up follow through looking left, we have thin structure to retrace. So you don't really want to be holding long positions as we're trading underneath 468.50. That would be a reason to stop out of longs and not necessarily be looking for new money longs until we form some sort of pattern, maybe off of the FOMC retracement, right? I could envision something that does this. We get here, and when we get there, if you can produce a stronger, hourly double bottom, that kind of sets up the lower high we were talking about on the daily time frame chart to then be thinking about 459 as a deeper pullback on the weekly, looking for that higher low, right? 459 is just a hop, skip, and a jump underneath us from there. There is the good old level. So the next thing we'll do is just finish this up on the hourly with our study set intraday VWAPs here. What do you notice? We're underneath all of the major inflection points, right? So this is the FOMC rally, this is the liquidation break, this is the high, and this is the first of the trading year. We're underneath all of them. So are the bears in control? The answer has to be 100% yes. The next thing we'll do on the hourly chart is quickly take out the fibs from the top of the move down to the bottom. And what you'll notice is that we get decent confluence at the 38.2 and the 68.1. So any consolidation that remains here is nothing more than bear flag consolidation from this perspective. And of course, a measured move would take you at minimum to the FOMC breakout, if not further, closer to that 459 weekly higher low target. Even if we do rally through this as a potential double bottom, you're still looking at confluence here and just reinforcing the idea that 473.75 can act as a strong resistance point, and it makes a lot of sense that you could still produce a daily lower high. When that happens, of course, we know that this starts to suggest your head and shoulders, then through the equal lows brings in the lower low, you're in a daily downtrend, and you're still looking for that same target to the downside. The strongest thing that the buyers could potentially do here is immediately rip to the open, get consolidation here, and then a break higher low as we talked about over 473.75. I would change my tone when and if we produce something that looks like this, but based on all of the evidence we've considered so far, it seems like a lower probability outcome. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. On Tuesday, there was actually a reasonable chance that we could have just seen that as a potential higher low pullback. Notice that the internals really weren't all that bad on the Tuesday session. Don't get me wrong, they were not impressive to the bull side of the market, but that's to be expected when we're moving in the downward direction. We just really didn't have any indications of stronger sellers stepping on the gas into the afternoon there. On today's session, though, when we break down for that lower low, at least on the bar-to-bar count, we know on the daily chart we are in equal low. Notice that we have substantial volume outflows. That, of course, is bearish. We're much closer to trend lower zone on the open, and we just crawl towards the zero line as opposed to on Tuesday, pretty sharp move towards that zero line. You'll also notice that the cumulative build on the tick goes negative first, then a mild move into the upward direction. I would argue that a majority of this has to do with the big impressions we saw to the upside on the FOMC meeting minutes release, but as we'll dive into later in the video, the meeting minutes were actually very hawkish, and in turn that, usually correlates to bearish moves for our market. So overall, I would say that the internals stack up on the bear side here. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it simple. Let's keep it visual. Where's the value area and point of control? Here is Friday. Here is the Tuesday session. And today's Wednesday session continues to migrate in the downward direction every single day. Value is clean to the downside. There is no overlap. The point of controls are mostly centralized in the overall ranges individually. So what that would suggest is that it's easier to turn the previous day's range into overhead supply as soon as you're underneath that point of control, right? The majority of transactions happened above us, so the sellers have control. The next thing to point out here is that there was no chance to even interact or transact in the upper distribution from the Friday session. Remember that we technically had a double distribution as separated by the C print single period, and you'll also notice that we had a lack of material excess on Tuesday's low that was repaired today as we traded through it, but it was replaced with a poor high, and we have great excess actually in the M period low from today's session. So market profile might suggest that an equal low could yield a repair first to the poor high. We trade, maybe tag this VPOC. We don't want to trade up to this VPOC up here because that would suggest a move up and over SPY 473.75. Remember that Friday's low wants to act as continued resistance, basically 4,800 in the ES. So tag this VPOC, rotate away from it. There's your daily lower high. And of course, if we scrunch this chart up, we can clearly see that all of this not only turns into overhead supply, but here's a nice little trick for you. Let's look left. This, of course, is Danger Red Ranger, thin structure, single prints J period from the FOMC rally. That's why I believe the pullback will likely happen on a snappy style tempo as opposed to a slow and lethargic move in the downward direction. Changing gears to the QQQ daily time frame chart, you can already see the astounding relative weakness to the S&P 500. In terms of trend, we've pulled back, yes, from the highest high, but we've already obliterated the equal low doing so on Tuesday. We did not produce a hammer-esque style bar, and there was no gap close overhead. It was a gap and go. Sellers are totally dominating over on the tech side of the market. You'll also notice that on today's session, we've closed underneath the origin of the FOMC rally from about mid-December. So bears definitely give you kudos over here in the tech side of things. I would not be partial to chasing lower lows in this particular trend sequence. I'd be thinking about where can we get involved on lower high entries underneath this level right here at 404.25. That would be ideal from a daily time frame chart perspective. If we continue to stretch this in the downward direction, we know that the weekly higher low pullback is somewhere here closer to 392.75. If there is going to be a larger reversal back in the upward direction, if we're going to neutralize this chart, it would have to be some sort of higher low in here and then really trading for consolidation in this range. I don't even know that I would believe the higher low over 404.25 out of the gates because there's still too much of an opportunity for a lower high staying contained within the original balance range here underneath 410.25. Maybe we'll actually use the same line in the sand as the S&P, which would be the emboldened sellers level, if you will. On the NASDAQ, that number would be here at 408.50. So let's give it maybe a gap fill reversal as a possibility for a daily higher, lower high, excuse me, if we were to produce a higher low above it, we'll change our tone, and that would be the inflection point right here. Once again, 408.50, but the primary look first, because of the astounding relative weakness, would just be a lower high underneath, and then weekly pullback buyers. You're looking for daily double bottom down here, inverted head and shoulders, the whole 9 yards at 392.75. Before we zoom out for our anchored view app analysis, let's take a quick look at the equivalent Fibonacci from the Thursday low up to the most recent high, and we're clearly underneath the 38.2, so that of course is a bearish indication. We're above the 61.8, but as you can clearly see here, this is just thin structure, and structure always supersedes, arbitrary Fibonaccis that aren't really providing confluence. Confluence gives us confidence, not much more than that. At the end of the day, yes, this is still just a number sequence. It doesn't really mean much in terms of positioning unless we actually have something there. So I wouldn't second mortgage the house here on pullbacks into 390, let's just call that 397 for round numbers sake, just kind of arbitrarily in this thin structure zone. Not for nothing, but this, as overhead supply in my eyes, can continue to weigh on price in the downward direction towards that 392.75. Let's throw on those anchored view apps now, though, and see where we're at from that point of view. Obviously, these are all the same anchors that we just discussed over on the S&P 500. We're above all of them. The main cluster below is much closer to like the 380, 381 zone. So still, from the higher time frame point of view, the big weekly pullback checks out as being something that we're still interested in as long as we're above that cluster. Let's take it on down to the hourly time frame chart. From a trend point of view over here, obviously we're in a downtrend as well. You're already in a daily downtrend, so highs, lower highs. What I find most interesting about Tuesday's intraday lower highs is that, again, because there was no gap fill reversal, it was just a straight out breakdown, right? Gap and go. But notice where the lower high is. It's underneath that inflection point here, the bottom of the daily range, at 404.25, and the end of day rally doesn't even come, it's nowhere close to the opening print. And even if it did make sort of an equal high here, you're still underneath the bulk of the balance range. So again, buyers didn't really have it going on at any point during the day on the Tuesday session, especially over here on the NASDAQ side of things. Now, what we're left with into the end of the week isn't really, I'm not thrilled with the price action from today's session. It really just gave us a balance area here, and it closed somewhat weak. So if you're going to do something into the end of the week on the Qs in terms of short duration trading, right, we're looking for lower highs under 399. This is sort of overhead supply in the very short and immediate time frame, and obviously any thin structure underneath that can be retraced, gets us closer to that weekly pullback level, 392.75. And if there is going to be a turnaround in the upward direction for a short-term hourly uptrend, right, to maybe do something like this and retest for a daily lower high 404.25, you need the higher low over $400.15. You just have to clear that with a higher low before you're partial to the bull side. Why would you jump the gun on that when it doesn't really make much sense? Let's quickly take out a Fibonacci on the hourly chart to again stay congruent with what we did over in the S&P side of the markets, and you can see that your 38.2 is roughly aligned with that 404.25. So still, even if we do get that lower high here, strong odds, decent confluence with that number, unlike what we saw on the daily time frame chart Fibonacci. This one is making much more sense, reinforcing once again 404.25. The last thing we'll do here is take a quick peek at the intraday anchored view app, see if we're getting any confluence, then we'll move into the internals for the NASDAQ. These are slowly going to start barreling down on that 404.25, so still just reinforcing this idea for a daily lower high, keeping the bears in control with highs, lower highs. Obviously, you had like lows here. This is a lower low. Daily downtrend is already in force over on the NASDAQ side of things. Let's jump on over to the internals, and I will have to just do this real quick, so bear with me as we let those load up. Let's just remove that so we get a little bit more screen real estate, and we'll zoom into what's going on here. So substantial volume outflows today. Absolutely, Tuesday was pretty bad as well compared to the S&Ps, which were a little bit more mild. Substantial volume outflows on the week, and we've only had 2 trading days. Typically, we check in on a Wednesday after we've had a full Monday, and we're looking for negative or positive 600 million out of the NASDAQ. We've already breached that on the close of today's session with only 2 trading sessions. Obviously, you can see over here in the advanced decline line, much more relative weakness today, pegged in trend lower zone all day, and the cumulative build really speaks for itself. The bears are in the driver's seat over on the NASDAQ. And market profile, just to bring it full circle, obviously you're getting value area marching in the downward direction. Same thing on today's session over here, as well as the point of control. One thing you will make note of is that the point of control was lower in the individual sessions over on the NASDAQ. So if there is going to be a relief rally, I think it can happen sooner in something like your NASDAQ. We're still looking for that lower high to be set, but just understand that the flip can happen faster in the NASDAQ as compared to the S&Ps based on where the most transactions have gone through. This is a level that, of course, you want to be partial to. It's the equivalent of the 404.25 we just looked at over in the QQQ cash, and it's 16, what's the number here? 16.8. 16.8 is going to be that volume shelf, if you will. You can see see that A period liquidation. That's the gap and go, right? And you still have this poor low that needs some repair. Lack of material excess at the high and low of today's session. So honestly, the NASDAQ, considering that it remains in control of the bears as of right now, I could see this going either way. And the most interesting interaction that could take place would just be the retest of this area. Once again, the QQQ equivalent would be at 404.25. And last but not least for the broad market is IWM Russell 2000 and the small caps on a daily time frame chart. I'm leaving it zoomed out just so we can understand and reflect on the idea that this is still very much so a strong weekly trend in the upward direction. Sure, we are getting some pullback just like the rest of the broad market, but a weekly higher low is still very attractive here at 187.75. Let's punch in a little bit now to our daily chart and zoom in here so we can see things with a little bit more clarity and talk about the trend and what's going on. We're flipping into a daily downtrend with highest highs in the sequence, breaking to a lower low from here to here. We did close the gap all the way from the day after the FOMC in this sequence back below. And the main idea walking forward is that if we get a gap fill reversal, we're looking for a lower high underneath the bottom of the range from back here at 196.50. Not for nothing, I've already taken a look. If we bring out the Fibonacci from the low of the FOMC breakout to the high of the most recent move, the 61.8 is beautiful confluence at this number. 193.60 is the low and the gap fill reversal area from today's session. So main idea is looking for a lower high to be set, then follow through here for a weekly higher low. We are looking for a daily double bottom, inverted head and shoulders, the whole 9 yards we're always looking for. If we're going to change our tone in the upward direction for the IWM, it really requires a higher low up and over 199, right? That's the low inverted hammer low breakdown. It was a gap and go from today's session. So in terms of relative strength and weakness, just like we talked about in the NASDAQ, the Russell certainly had some relative weakness today, gap and go lower, breaking the bottom end of the range and getting some, filling of the gap, if you will. And we still have thin structure underneath. Like, let's not forget that this FOMC rally, we'll see it on the hourly in just a second, but there's really not much structure in here. So if we do just get straight up continuation, I would not try to be the person who tries to catch the falling knife in this range. Even if there is a reversal, just let it reverse and then wait patiently for the higher low, like back up inside of range or even over 199. Then we could say with a little bit more confidence, yes, this is a weekly higher low. But if we're just in there and you're trying to catch that falling knife, I think there's too much risk that we ultimately get that full follow through into 187.75. I would not be a participant for that type of idea. Again, the whole reasoning behind that is that we have thin structure. So instead of continuing to talk about it, let's take a look, but only after we remain congruent by taking a look at the VWAP spread here. The idea is just that these will get closer over time to our weekly higher low. It's the same idea as what we've discussed over in the NASDAQ and the S&P. Here's the hourly time frame chart for our IWM. You can see clearly that the lower high rejection inside of range on Tuesday's high, or just on the heels of an already lower high from the Friday session. So that really shouldn't have been all that surprising. Underneath 202.20, the bears had control with the sort of failure into the range on Friday, which happened before the breakdown over in the NASDAQ and the S&P. If you haven't been paying attention to this, in the pre-market preps, we've been very clear that you need to be watching all three of the major indexes. The IWM and the Qs being in sync is the largest tell that the S&P is going to see follow through. If they're divergent, you probably don't want to press your luck in the S&P by itself. In terms of what happened at the bottom of the range, I am fairly impressed that the buyers continued to put up a fight here up until the bitter, end of the day's session. So it looks like the buyers are trying to step up in IWM, but we definitively need an hourly trend reversal before, again, we try to catch that falling knife. Here is that thin structure I was referring to. Probably don't want to get involved arbitrarily throughout this range over here. Let's quickly take out the intraday anchored VWAPs, if you will. Underneath all of them, again, no surprises. The main reasoning for the higher low over 199 is not only structural, but you can see that the anchored VWAPs are cascading down around this area. If we were to see a stronger reversal, this becomes much more confidence inspiring for the buyers to produce some sort of follow through in the upward direction. Last thing we'll look at here before moving on over to the internals for the small caps is the same Fibonacci from the high up to the low, and lo and behold, your 38.2. It's closely aligned. It's not beautiful at 199, but it's pretty darn close enough for horseshoes and hand grenades, as they typically say. Let's move along and take a look at the internals for the Russell. Substantial volume outflows on today's individual session. Outflows for the week are substantial as well. Negative 173 million. The threshold is negative 125 million, or positive in the case of an up day or up week, obviously. The advanced decline line is much closer to trend lower zone, or at least not trending in the upward direction towards the zero line like the S&P was. So relative weakness on that front. And obviously your cumulative builds down here in the tick really speak for themselves, getting negative negative and falling on today's session versus the S&P, which was a little bit more positive. So again, chasing the lowest low in the trend sequence out of the IWM, I would be partial to this as the primary idea based on everything we're seeing. The stronger sellers are starting to get involved, but I would look for that lower high, noting that the buyers are trying to respond. You want to look for some place where you can clearly manage your risk, right? If we break down, you could technically position against something that's like that, but it's just not nearly as strong. So an opening drive lower that then maybe is like a lower high underneath a descending VWAP, maybe something like that is on the docket for a potential short trade if it's just straight up continuation. We're just talking about possible scenarios, right? Let's finish up the IWM and small caps as a whole with our market profile. And what you'll notice over here is just the sharper liquidation on the Friday session. And that really shouldn't come as much of a surprise. We noted the lower high already underneath the top of the daily balance range. The point of control and value area was down there. The thing that I want to make note of is the extreme lack of material excess, just incredibly poor high on the Tuesday session and the low. That has not been repaired because we did not trade for a full gap close on today's session. We did see the point of control flip in the downward direction towards the lows of today's session. And this is really those market on close orders going through. So I would really treat this as a double distribution. There's decent excess at the highs, okay excess at the lows. The upper point of control is probably somewhere in here. I wouldn't really look at this and say, oh no, it means that people were buying down here and we have to see this rebound. It would support the idea of a gap fill reversal, but still the primary outcome I would be thinking about here is that lower high underneath the bottom of the daily balance range. In the Russell futures, that would be anywhere underneath 2020 basically as your line in the sand. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that utilities lead the pack here, up 2.27%, followed by energy, healthcare, and consumer staples, all really defensive sectors, maybe outside of energy there. At the bottom of the barrel, it's the XLY consumer discretionary, down up and over 2.5%. The tech sector also down up and over 2.25%, and these are the heavier weight risk on style sectors. The XLF is also falling into that category, but not down nearly as bad here at the bottom of the list, only 16 basis points, which is not nothing, but it's definitely not over 2% lower. So the issue becomes like, is this a risk off rotation? I mean, the answer is technically yes, but is the market also pulling back? The answer is also yes. So this is exactly what you'd expect to see as the S&P itself as an index is moving lower. If the market was continuing to march in the upward direction, and this is exactly what the posture looked like, that would be a huge red flag. Of course, you would not want to be chasing longs in that case, but because the market's pulling back, you're seeing a risk off rotation, things kind of add up here. So the risk-off posture doesn't strike me as overly concerning. The issue now that we have to care about is if the market starts to rebound back in the upward direction, is it being driven by the heavier weight tech sector, the consumer discretionary sector, or financial starting to outperform? If so, maybe we can trust this as a low, but if it's only being driven by, positive gains out of utilities, healthcare, and consumer staples, we're not trusting this as a daily equal or even higher low trying to keep us within the balance range. It's just not how it works, right? That's still a risk-off rotation, even if you're getting some sort of lift after a bit of a drawdown. So hopefully that made sense, wasn't too convoluted. Let's check in on the structural charts and see what's happening from that point of view. If it was too convoluted, let me know in the comments section. I can try to answer or provide some more context around it if you have specific questions. Anyways, utilities, I mean, higher low on like a weekly time frame chart, but still well underneath the FOMC rally highs from back over here structurally, or even like, posture-wise in the grand scheme of things. Is this about to break to a new all-time high? No, absolutely not. So not concerned with that. Energy, it's the first daily bar or meaningful daily bar. Technically, this inverted hammer over here closed over the neckline at 85.50, but this is the first powerful close above. So if this is going to be an inverted head and shoulders, technically we're looking for higher. Energy, as we know, actually speaks to global demand for oil, if you will, to some magnitude, and that would be healthy in terms of avoiding a recession. Now, the counterpoint there is just that this is not moving higher for the right reasons. It's not global demand for oil, it's just the tensions over in the Red Sea, and obviously shipping costs needing to increase and the threats that are associated with that. So we'll continue to monitor that, but as of right now, it doesn't strike me as like an end of the world style move. Healthcare, on the other hand, is a little bit more perplexing. I mean, this is a big time move in the upward direction, and not for nothing. If we just go out to a multi-week and year chart, we're basically towards the top of the balance range, right? So if this is going to break out and see a big move throughout 2024, that's a possible macro theme that would tell you, all right, probably looking for underperformance from tech, discretionary, discretionary, and outperformance from consumer staples and healthcare. Those would tend to go hand in hand into the year. So I'm watching this as a higher time frame theme very closely, especially after the breakout on the Tuesday session. I mean, that was a really, really powerful move as the broad market was lower. And again, remembering that this is the second heaviest weighted sector, this is probably what's keeping your S&P more neutral as compared to the NASDAQ, which is just falling off of a cliff basically on a relative basis. Here's consumer staples. Again, a strong move on Tuesday, but giving back much more compared to healthcare. It still made a higher high and it's marching in the upward direction. If you zoom this chart out though, let's do the same thing and go out to like a 3-year weekly. It's not even close. Not even close to the top of the range. So, big risk off indication, big macro shift, not so much so out of consumer staples. Next up is consumer discretionary. I'm going to drop this one back down to a daily chart here. And we want more than 3 months, don't we? We want the full gamut year. There we are. What you'll notice here is a strong pullback, right? Very, very strong pullback. Multiple days cascading lower on increasing volume over here. Kind of approaching a line in the sand. Not for nothing, but the weekly chart wants to find a higher low outside of this as a previous, I would just call it congestion range. So 171.50. We're not there yet. And again, this is one of the reasons why we're not yet buying the S&P pullback. But if this can come into this zone, start to find buyers, and then rotate higher, I mean, not for nothing. Let's just bring out the fib. And we'll come in from the low up to the high. I mean, that's still over your 38.2. So is this technically a healthy pullback? I would argue 100% yes, especially if this is happening over the congestion highs at 171.50. So is there continued room to pull back? Yes. When we get there, will we start reevaluating what's happening in the S&P? The answer is also yes. Let's do the same thing over here in the XLK tech sector. We know that these are all-time highs. Pullback from all-time high, I mean, weekly high or low is possible. Ideally, it would have been here. I'll give credit where credit is due. The sellers did do a great job today producing that inverted hammer back down inside of this as a balanced range. So if we do continue to pull back, I mean, this starts to look a little bit more concerning, but not for nothing. As long as you're over the top of this box on a monthly time frame chart, you're still good to go. We don't want to keep moving the goalpost. That's one thing that you might find flawed in this style of analysis is that, like, we talk about daily higher lows, we talk about weekly higher lows. You don't want to just continuously arbitrarily move those goalposts, but for the most part, pulling back from the all-time high, yeah, we'll trade in the downward direction. We are not going to be looking for that SPY higher low, viable pullback there until the XLK really more meaningfully bottoms. When we've violated all of the daily, weekly, and monthly higher low opportunities, then yeah, now we have issues on our hands, and we're talking about a substantial structural shift that goes down to the core of sector posture for the S&P as we navigate into 2024. So a little bit of a longer discussion point there, but wanted to be clear on that because I can understand how someone would just say, oh, when the daily higher low doesn't happen, you just push the goalpost. I get it, and it's definitely a concession I would make. Here's the XLI Industrials all-time high, pulling back from it. Yes, we are underneath this area here. Can it continue? Yes, because we're technically in a daily downtrend with highs, lows, and now a lower low. If we do pull back further, this is the weekly inflection point I would be thinking about here at 109 flat. This is about 8% of the S&P, so certainly looking for that to bottom out as well. Real estate, much more of a lighter weight sector, does not have nearly as much impact on the index as a whole, unless it's making swing highs, swing lows, currently just staying consolidation or staying in this consolidation range up near the highs. Not overly concerned with that. XLB Materials, the lightest weight sector in the S&P. Unfortunately, this is the best looking doji compared to some of the other weaker looking bars we've already covered, and it's happening at key structure. And again, unfortunately here, this is just a lightweight sector, so it's not going to make much of a difference if it holds and continues to balance. It would be nice if that's what the XLK was doing, but it simply is not, so this cannot act as a saving grace. Communications and financials are the outliers. The pullbacks have been much more mild, and you can still see the clear opportunity for a daily higher low, I would argue here, up and over 71.25. The weekly higher low would have wanted to happen somewhere here. I guess at this point it's an equal low on the weekly chart, but nonetheless, this mild malaise in the downward direction leads me to believe if communications are going to catch the baton in terms of relative performance, this would be a decent start to any sort of risk on rotation back in the upward direction. We need indications of that first, and today's inverted hammer is nothing of the sort, so expecting further pullback, expecting an interaction with 71.25, and again, that leads you to an S&P that can also break the bottom of its daily balance range. XLF, on the other hand, is not as close to producing a more meaningful pullback. I mean, in this one, you've got to break down underneath the Wednesday liquidation break low and get through this thin structure for the weekly higher low test at 36.30. It's just not even close. I mean, you can still see that we're up and over this area here, which had the opportunity to act as resistance after the small rebound. There was no lower high underneath, quickly and promptly recaptured, produced a higher high. Really hard to be bearish on financials when the chart looks something like this. So sure, could a pullback ensue? Absolutely. But again, as long as we're over this 36.30, I would start using that as a deeper line in the sand. As long as we're over that, good to go in financials, remembering also that this is the third heaviest weighted sector and certainly speaks to more of a risk on sentiment. So if financials pull back and tech continues to pull back, this would be a stronger indication, waiting for that bottoming process at the 3630. And then we'll say for the index as a whole, yes, we can start to look for a buyable opportunity. Weekly high or low, we know that we've been 9 weeks vertical with no pullback. So again, in terms of managing expectations, this is the next thing to point out. I would probably manage your expectations in terms of 2024's possible calendar year return. We're just off the heels of 24+% return in 2023, I probably wouldn't be thinking about a similar size return in 2024, something lower than 24%. I'd love to be proven wrong, but it just doesn't seem like that's in the cards unless the promise of AI is dramatically, fulfilled and we see a massive runaway from productivity. We'll get to that as charts continue to develop, but let's stay sticking to the script. Let's move along into more supporting evidence. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set it up. Overall, I think these indications still tell us that we don't want to buy the pullback just yet. Look at this breakdown through a still upward sloping 50 SMA, but certainly not a warm and fuzzy feeling inside for risk on. The exact inverse over here in the XLV breaking through the 50 SMA. We also saw that structural chart, just an incredible break to the upside. This is more D for defensive posture, right? And you might say like, oh, but look at the XLF. This is still a very strong looking chart. And you're right, in the short term, it is a very strong looking trend here. But just recall, if we drop these back out to yearly timeframes, there's a lot of work that needs to be done out of the financial sector compared to what's already taken place out of tech. Similar story over here in the XLY, constructive and maybe an opportunity for a higher time frame weekly high or low. But if you go out to like a daily time frame chart, or excuse me, a yearly daily time frame chart, you're really just much more so in the midpoint of this as a balance range, whereas this, as we had pointed out, had already done its fair share of the work. In terms of risk off indications down towards the bottom, perking up, but not yet over a 50 SMA. So keeping an open mind to these, but they're certainly not comfortable, and again, would suggest that we want to be a little bit cautious trying to buy a pullback just yet. Probably some more room to move in the downward direction before the pullback is cemented and we can look for higher lows. Let's get into some specialized ratios. Again, too much give back happening here, still over an upward sloping 50 SMA, so you can catch yourself there for a higher low, but not yet confident in the pullback. Let's move along and take a look at XLK versus utilities. Similar concept, but again, there you go. There is actually a lower low on the table out of this particular ratio, and notice that in previous instances when the market was rallying, at least, right, this was a higher low, this was a higher low, this is not a higher low. So do we want to trust this pullback just yet? Probably not. This is another one of those indications. Let's move along and look at apples to apples. This one looks decent. If there's going to be something that holds, it wants to be this ratio right here at the top of the previous range, confluence with our 50 SMA. We've been talking about this pullback for a while after setting these higher highs. This is the only one that sort of looks good and doesn't have too much of a give back based on the preceding balance range from over here. Is this a 100% retracement? Don't get me wrong. The answer is 100% yes, but we have the opportunity now to use prior resistance into newfound support, newfound potential support there. And now we have the confluence with that 50 SMA. So this is one of the 3 specialized ratios that would suggest that, okay, we can be aware of higher low pullbacks, but the other 2 would tell us, probably not yet based on the performance of those. Let's take a look at the dollar and what's happening over here. Sharp rebound off the bottom end of the monthly balance range from back here. So again, any surprises? Not really. It would suggest that a pullback is reasonable here. I would watch for the dollar to get into 103.50, and if it reverses off of that level, that's when we're more confident in the S&P pullback being more firm and holding that as a higher low, right? Let's check in with the gold contract. Big old fake out, right? Moving back in the downward direction. It's not yet a double top, so I wouldn't think of this as like, oh no, it's got to move, all the way back down to down here, 1850. No, there's still an opportunity for consolidation up and over the 2000 mark, but the all-time high breakout has sort of failed. This is looking more so like a lower high, failing to hold on to this as a breakout point. If we really zoom into this, you can start to see it, right? So we're back down underneath that level. If we get the full retracement, I would tend to think that gold starts to chop around. Remember that the metals, they tend to act as a heartbreaker trade. I have never really been fond of trading them, but using them as an economic indication, sure. If we look at silver, it's the exact, it would be a magnification of the failure from gold, right? And we know that silver has acted as a leader recently. 100% retracement, basically back down at the lows. So do you want to be long gold? Probably not, indicating that yes, the dollar can seemingly move higher, which in theory puts downward pressure on equity. So these relationships are still making sense for a pullback as well. So far, all of the narrative revolves around, yes, we are looking for a continued pullback here in the S&P. It's not like the market structure has substantially deteriorated. The market's not going to hell in a handbasket, but we're not necessarily jumping in there willy-nilly looking for new money longs yet until we get to some better structure or the risk on sentiment starts to pick back up. Here's the TNX. Interest rates did move in the upward direction over the first 2 trading days, but faded intraday. As long as we're getting lower highs underneath 40, in the TNX, it's 43.33. In the 10-year yield, it would just be 4.33, right? We're approaching that 4% psychological area. We continue to get, pushed away from it. So there's plenty of room in the TNX to move in the upward direction and still maintain a counter trend style move, right? You can get highs, lower highs here. You could still get a weekly equal or even lower high on a monthly time frame chart. Again, I understand the goalpost moving thing, but a lower high here underneath 43.30, on the TNX, no real issues with that. And sure, we got the FOMC revisions today. How did the inverted ZT react to this? The Fed tried to be more hawkish in their stance in the release of the minutes, but notice what the inverted ZT did. It didn't even budge. So let's take a look at the tracker tool and dissect what was actually in the meeting minutes. So this should really come as no surprise that the tracker tool also did not budge. We're currently pricing in, or I should say the market is pricing in 6 rate cuts in 2024, which is more than double the 2 that the SCP outlines, maybe 3 on the high side, depending on your interpretation there. We can specifically look at the odds on today's session and how they changed for the March timeframe. Remember, March is the first forecast of a rate cut currently. Yesterday, we had 69.5% odds. Today, we have 65.66% odds. So, sure, it ticked lower on the release of the meeting minutes, which happened to be far more hawkish than many folks expected, but we're still, or I should say the market is still pricing in aggressively. No, Powell, you can put your tough guy face on, but we're looking for a cut as soon as March. If we look at some of the verbiage from the meeting minutes, I thought it was very interesting how this was phrased. There was a lot of easing in financial conditions that reversed some of the tightening that occurred over the summer and much of the fall. So this is Jerome Powell saying, you've undone basically everything we've worked hard to achieve over the last little bit. This is him trying to put that tough guy face on and say, market, you can price in all you'd want that, we're going to get a cut in March, but it's just not going to happen. So this is the tough guy look. The market, again, sees this and hardly moves, doesn't even budge there on the Fed tracker tool. The next thing to pay attention to is the commentary around the dual mandate. Really, the risks of inflation and unemployment are moving into a greater balance, meaning that the Fed is maybe going to start focusing more so on the labor market remaining intact and not skyrocketing in terms of unemployment, even if inflation starts to move slightly in the upward direction. This is basically a declaration without outright saying it that, hey, we think the war against inflation is ultimately over. And I wouldn't call him wrong for saying something like that. If you look at rent inflation, which is the primary driver of services inflation for most folks, you can see that we're back to pre-sickness trend over here, and this is the data that's coming from Zillow's observed rent index. So again, I don't think it's wrong that the Fed is starting to focus on the labor market. It seems as though inflation will continue to subside. Speaking of labor data, we got the jolts coming out today, and this is continued evidence that the labor market is cooling, but we're not running into trouble yet. We're still well above trend here. This is the number of job openings per unemployed person in the jolts, right? We're still above the pre-sickness trend, and that, of course, would be an indication that, okay, things are so far so good. Jerome Powell is trying to navigate this plane for a soft landing. Doing good so far, but as we just saw in the screenshot from 2 slides ago, we have to start paying attention to more so the labor reports compared to inflation. So what do we get into the end of this week? It's none other than continued labor reports, right? The ADP has been wildly divergent from the public non-farm payroll over here, and this is really more so what the Fed is watching. So we'll keep an eye on this. It is a move in the downward direction, but as long as the unemployment rate itself over here remains historically low at 3.8, 3.7%, which was the prior, not really looking for anything dramatic to take place. If you've been following along with the weekly initial claims, we haven't really gotten any big blowout numbers. Remember that here, we're really starting to become more concerned when and if we get reads up and over 250K, and it just hasn't been the case over the last month. So I'm not really expecting that this number would be dramatically higher. When and if this starts ticking in the upward direction and this continues to fall, now we have some issues, right? So we'll continue to watch for that dynamic, but the Fed has basically telegraphed, hey, watch labor data. We believe that inflation is going to continue to subside. Let's see how it plays out. Some of our risk appetite indications are starting to say, hey, dial it back just a little bit. If you look at the TLT ratio to the S&P, it broke far in advance of when this rally has sort of come to a stall, if you will, into the new year, and it remains somewhat elevated in terms of the ratio itself. But remember, as this was taking place, we made note that supporting evidence wasn't really suggesting that it's time to panic yet, specifically out of short-dated bonds in relationship to themselves, and they're still not suggesting anything big. There's a little bit of an uptick here, counter trend move, counter trend move. These are still pretty much okay. But where we start to say, all right, let's be a little bit more reserved is if we're looking at credit spreads in particular. And there was some commentary in the meeting minutes from the Fed that suggested, hey, it's very possible that there's going to be a big, I shouldn't say big, I shouldn't try to strike fear in that way. But literally in the summary, I'll put up a screenshot right now, actually, I'll dig through it and find it. There was a suggestion that commercial real estate is going to get hit big time, and that really sent credit spreads in the upward direction over here. We're not through 50 SMAs, we're still underneath, we're still in overall downtrends, maybe not so much in the medium time frame IEF LQD, noting that this is possibly a double bottom. We're up and over that neckline. This is still suggestive of a lower high after producing a lower low in the short term, SHY, HYG. So it's not like, hey, run, duck, and cover, this market's going to come crashing down, go to hell in a handbasket, but it's like, hey, some warning shots across the bow. You really want to see these things roll back over if you're looking for that pullback to hold in the S&P. So trying to navigate that, keeping a close eye on how these continue to progress probably over the next week or so, as and if the market pullback we're sort of expecting continues to play out. Let's look at the HYG in isolation. It's actually married up beautifully with the S&P sitting on an equal low, If the HYG goes, you're probably looking for the S&P to go. If the S&P goes, but the HYG does not go, that would be a bullish indication. And hey, we'll monitor some of the other things happening with credit spreads, TLT ratio to the S&P. And if it makes sense, sector-wise as well, by the way, if it makes sense to try to take a stab at that divergence, positive divergence from the HYG holding up, we'll take the stab when and if it presents itself, but we're still just dealing with currently the equal lows. So taking this at face value, let's move along and take a look at the BTC, the breakout that was promptly reversed back in the downward direction, catching a lot of folks off guard who are like, okay, it's the year, Bitcoin is off to the races, first day of 2024. Immediately reverses the entire move. So back down in this consolidation zone, look above and fail has been achieved by tagging the bottom end of the balance. The next look is definitively waiting not for a break, but a higher low above now. That breakout point, $45,100 per coin, or some sort of breakdown underneath the bottom end of the range over here. Oops, we've got the text tool, don't we? And we want the upper pane. Some sort of breakdown, if you will, underneath this zone around 40,600. That would bring in a larger downside move, and we know we're looking for a monthly pullback around $31,250 per coin. Overall, just the commentary on Bitcoin is that the fake break has me a little bit skeptical, and it really ties in more nicely with this equities risk appetite being reduced here as we move into the very near-term future. This would be a big help for looking for a deeper pullback. If we continue to consolidate, a little bit more neutral, and as we know, just the general disclaimer, this is not a one-to-one relationship with the, quote, regular financial markets down below. Regular and regulated, I should say. Let's move along and take a look at some market breadth. This is where there's a little beam of hope. It's not necessarily out of new highs versus lows. This is actually not very impressive, making a move closer to the zero line on what appears to be a very mild pullback in the S&P so far. This is not a bullish indication, but if you take a look at some of the other breadth indicators we watch, so SPX A200R stocks over the 200 SMA, continuing to tick higher. Same thing over here in the SPX A50R, continuing to move or just stay elevated up near 90%. So if you want to be a contrarian, this is screaming like, yes, it's time. And this pullback, if we can bring in a lower low, would also say, yes, it is time for some sort of pullback. So if you're looking for an overbought pullback, this would be on your side, but it's definitely not, hey, we're moving into a recession. Everything is pegged underneath, 20% in the SPX A50R. So contrarian indication, yes. Armageddon indication, no. And the beam of light I was referring to is just that the equal weight indexes are still holding up technically over prior highs. I understand that the S&P weighted made an equal low. This is technically an equal low as well, so they're more so on par. But remember how much of a struggle it was at the bottom over here to start to get some movement in the upward direction. This had far surpassed the equal high way sooner than what had happened over in the RSP. So the fact that we're holding on to a thread, a small thread of hope here, is the one beam of light among everything we've analyzed so far that would seemingly suggest, okay, not, there's, again, just one, let's just put it as simply as we can. One bullish data point among a myriad of slightly more neutral or, hey, watch out for a pullback style data points. So weigh that accordingly. I know how I'll be interpreting that, as this is just like, again, one data point in a massive sort of collection that we're gathering. So it's not really going to tip the scales. We're still looking for a pullback. But if things start to improve and these remain stable, that starts to give you more confidence when and if some of the other indications start to improve. That's generally speaking how the analysis should always be sort of conducted here. So same thing in the QQQE. I know I'm belaboring the point at this point, and we'll move along to transports. This is going to be one hell of a lengthy video. Look at transports versus industrials. I mean, I don't even know why I drew that in. It's because I'm trying to talk and finish this up at the same time. But we're underneath the neckline in transports. This has always said or somewhat been cautious and skeptical of the rally. It has never made it up to the equal high. That's what I was going for originally. And this, of course, is also suggestive of looking for the pullback in the S&P. Man, I'm going to have to do a better job in the next episode we produce to not be such a rambling and ranting person and just give you the pertinent information. Anyways, VIX suppressed on the lows, still underneath 15. Not really an issue over here in volatility. If it is going to spike, we know that it's going to come from the precursor over in the VVIX. And if we take a look at the VVIX, it is still stable in the midpoint of this as a range. We will become concerned when and if we move over 103. Currently, does not appear to be an issue, but we're keeping an eye on it, noting that we're elevated off of the lows. This, just like credit spreads, is likely something I will monitor on a day-to-day basis into the end of this week and even early next week. Generally speaking, I'll often flip through these charts on a close of day. I'll flip through them maybe every other day when I think something interesting has happened, but under the current circumstances, I'll be looking at these every day, specifically in credit spreads and the VVIX we were just looking at. Contango versus backwardation, moving towards a backwardation, but just understand where the zero line is, just not even remotely close at this point in time. Can it flip quickly? Yes, but you'll know when it's flipping, right? So we're not there yet. I would not be worried about an Armageddon-style sell. Even the one-day VIX, which as we know, can have more impact from the 0DT options that we're generally gauging. It's still suppressed underneath this. This is when things were really nasty in October, moving to the downside. So I'm not really seeing any larger indication volatility-wise that, hey, it's time to buckle up. We can even go to the skew. Just why not? We've made the video this long already. We'll throw in the skew here. The skew is also not doing anything overly aggressive, right? It's just on the lows of this balance. And remember, the skew is much more meaningful when and if it gets underneath 113. For a bottom picker, at least at the ties, it's really just indicating that people are sort of fearful of the future. The fear has already sort of come and gone from the Wednesday liquidation break of 2 weeks ago. Now it's just kind of like, okay, everybody's patiently waiting for the next move. There's a reasonable amount of hedging that's taking place, which is logical based on how we've pulled back thus far. And, we're not really seeing any big black swan things on the horizon here. Remember, a black swan is always because you can't see it, so if one does come around the corner, nothing's going to pick it up anyways. Regardless, I'm going to shut up. We're going to get into the core list of companies. Apple kicks us off as it always does, and a big shout out to Barclays for the downgrade here on the calendar flip over the weekend. Really appreciate waking up to a Tuesday morning massive gap down out of the heaviest weighted component of the S&P. Jokes aside, we'll take the chart at face value. You've got to think any continued price acceptance below 188 turns all of this into overhead supply. Think about it. Anybody who is chasing this move and sort of saw, oh, look, bull flag consolidation will take the break for leg number 2. They are all underwater regardless of how good the entry was on the pullback here into the early stages of December. We've got a bearish 3-bar play on the daily time frame chart, and if we look left, this is incredibly thin structure. Any breakdowns underneath 181.75, or honestly, a breakdown of the 2 equal lows starts the move. You can see a little bit of a dance here. So more definitively, underneath 181.75, the door is wide open through this thin structure until the next somewhat relevant area around 177.50. Let's take it on down to the hourly time frame chart. If you are looking for an early morning scalp, maybe tomorrow for like a counter trend, hey, Apple's oversold style move on the gap down, you're probably looking at something over 184.75 right here. But just for a retracement up towards these highs, where you can clearly see in the first hourly bar, sellers were like, no, we're pushing price in the downward direction. Or any longs from overhead are like, all right, let's get out while we can, guys, and just close out all of these longs. So not overstaying the welcome on the long side unless we get some sort of daily higher low up and over 188. Based on the price action from today, seems a little bit like a far-fetched dream at this point. Let's move along and take a look at Microsoft, and we can keep this on the hourly chart just because there are so many levels to sort of be aware of. The chart is, at this point, I would say neutral. In the midpoint of this range after a look above and now failure back down to the bottom, that has been achieved. This was looking like ascending triangle, right? We had this and a flat top. Obviously, it broke down on the Tuesday session. It was not immune. There was a decent long on a thin structure retracement through the Tuesday morning breakdown on the morning session today. But now that you've gotten this as choppy activity, probably less interested in any, retracement moves in this range. And exactly as we pointed out, to me, it's definitely a back burner idea, being patient on this one until we can get a break and a definitive higher low over 373.50 or a break and definitive lower high underneath 368.25. Until either of those two things happen, probably less interested in Microsoft trades in the balance range. Google is a little bit more interesting. We sort of reassessed our levels, and you could think about Google as a possible daily lower high up against 140 on the retest, right? This is technically overhead supply here. Anybody who is buying this looking for, okay, let's see if we can get this to move in the upward direction, rejected. Anybody looking for an out at break, even 140 turns into your key rejection point. So if we're thinking about the theme of tech remaining somewhat weak, so maybe you would favor Microsoft breakdowns from the balance range, Apple continuation in the downward direction, Google lower high up against 140, you're then looking for a move back down to 138. Now, because 138 is the double bottom neckline, you could say that you're stronger short if you don't want to get participating here, which in my eyes is the better risk reward, right? You put a stop here, you enter as close as possible based on the intraday pattern. You're not a blind short up there, but then you're looking for this. Your risk is very small right here as compared to there. The stronger short, or I should say the more confident short, is looking for an equal low breakdown through this, determining that, yes, this in hindsight was a lower high. This is what you start to trade for, after that. That would be underneath 137.15. So either way you want to slice the cake there on Google certainly makes sense. Let's move along and talk about Amazon. This one, let's go to the daily chart on Amazon because I think that this chart is a bit more constructive. We're not really bullish on Google, Microsoft, Apple, but Amazon is a different beast. Now, the daily bar does not look good. Please do not misunderstand what I'm saying. But from a trend capacity, we have lows, higher lows, higher lows. And, technically you could produce higher lows above the top of the breakout point here at 147.60. Again, I want to be very transparent that the daily bar structure is not warm and fuzzy in terms of, hey, let's just, start buying this as a pullback. If we take it on down to the hourly chart, you can clearly see that we do not have any signs of an hourly trend reversal. This is, overhead supply. We did not support out of the 2A high breakout point. As a matter of fact, we're turning that into resistance now again at 150 instead of treating it as support for something that would have been a little bit more constructive like this. So again, do not misunderstand what I'm saying. Amazon is not bullish yet, but the daily chart looks the best of some of the tech names we've been watching. If we can hold 147.60, that makes a whole lot of sense to manage risk against. Something that does this and then breaks over 150. We're starting to look at this through the lens of inverted head and shoulders. There's your neckline. Over 150 is constructive. You get the idea. If we fall back down into this as a balance range, more similarly to Microsoft, this is kind of just like a no-touch play, not really all that interested in there. Perhaps a lower high underneath will retarget the bottom end of the range at 143.30, but less interested in Amazon as a whole because it's too counter to the daily trend. Let's move along and take a look at NVIDIA. NVIDIA has a couple of patterns in force here, specifically on the hourly time frame, or I guess maybe mixed with the daily. If this is your double top, look at the rejection on Tuesday in the mid-morning underneath your 484 neckline. That kicks off a daily downtrend with a lower high and a lower low. If you are going to get a rebound, obviously you want to stay underneath that 484, so that is your key upside level to be mindful of. If we continue lower underneath these equal lows, which clearly has lots of price history at 476, lower highs, breaks, you're looking for a pretty deep, maybe not all the way, but basically to the 50 SMA. Then the big test next would be at 460.50, right? So 50 SMA first target here based on this pullback low as well, closer to 469. You guys know the rules up here in the penthouse, round numbers only. Let's adjust this together so you guys know I am being truthful. There you are. So 469, there is the number. And there's the 50 SMA as well. Let's go to the daily chart. And this video, man, it is a ranting and rambling. Inverted hammer closes underneath the preceding bar low. If the buyers were going to make a stand here, it made a lot of sense for a potential hold of 476. You're not really getting a strong indication of that just yet. So probably a bit more bearish on NVIDIA, drifting into a daily downtrend with the break of that neckline via the double top we had just discussed. Here's Metaverse. We've reassessed our levels in this chart as well. This is more similar to Amazon, to be honest with you. I would follow along with Amazon pullbacks, and I would follow along with Meta pullbacks more so than some of the other charts we've been assessing so far. Again, the daily bar is not constructive yet, but we are holding on to this as a key zone. Here it is on the hourly chart, still nothing more than a bear flag, but notice, right, on Microsoft, we already had this thin structure retracement. That trade is on the table for Meta. A breakout up and over 346.75 would yield something I would imagine that could easily go to the opening print of Tuesday and the low of the Friday session here at 351.75. Not for nothing, but here it is on Microsoft, right? This is the same exact idea. When we broke that level on the morning session, there is your thin structure retracement to the high of Tuesday and the low of Friday. So take that same concept concept and apply it to what's going on over here in Meta, that's the exact same breakout trade you're looking for. On a 5-minute chart, you're looking for higher lows over VWAP once the break takes place, the whole 9 yards. You could look for an hourly higher low if you're really someone who needs confirmation. That's the idea here if the daily chart is going to remain constructive. And again, this is all coming from the breakdown of a rising wedge. So it makes sense that the snap happened. We had these very incremental higher highs. Remember, that's the psychology behind the rising wedge. Buyers get fed up with it. You get the snap. We've seen the snap. Sometimes markets need to break before they can rally. If the rally is going to come out of Meta, it's got to be up and over 346.75. Enough rambling. Tesla is up next. Let's continue along. This chart just looks bearish, to be honest with you. I mean, we have just a complete collapse of this breakout. We're back down inside of the daily balance range. Here it is on the daily chart, right? We've moved towards the midpoint of that range from a nonstop fall from the top. So I'm not convinced that you might want to be a new money short in the midpoint of a choppy balance range, but instead you could look for 2 trades on the hourly chart. So just like we literally just covered in Meta and the Microsoft recap, right? This is that same idea here, up and over 241.25, but the bigger takeaway out of Tesla is that you're just looking for a rejection on a retest of 246.25. I would not remain constructive for massive follow through out of Tesla as long as we are underneath 246.25. So short-term scalp, sure, then looking for a reversal back in the downward direction off of this particular level. Last but certainly not least is Netflix. Then 2 trade ideas. We're not even going to cut the tape. We're just going to transition right into them. If that's your inverted head and shoulders, you have your thin structure up and over 472.50, and your retracement would be into 481.75 coming from the daily time frame chart. As we look back here, it was the daily highs, and obviously you can see it's the origin of the Tuesday breakdown. Tuesday, honestly, that one caught me off guard. I was not expecting Netflix to fall so aggressively. So I'm treating this one with a little bit of psychological caution. I don't want to get wrapped up in the mind games of trying to prove the market right. Now I'll just let the trade come to me, and I would prefer to see something that looks like this. We'll take our stab if the risk reward is correct. If it just consolidates down here, not really thrilled with trying to chase shorts after the big break that already took place on the Tuesday session. Okay, first trade idea, JNJ, and I don't even think I've mapped out the levels. Those are old levels that are happening there. Let's clear the drawing set. We'll go out to the daily time frame, and we'll take a closer look. So for those of you who have been around the channel, you probably know exactly what I'm about to say, but we have a bullish 3-bar play on the daily time frame, and I would be looking for a break over the inside bar high, and the target would be somewhere over here off to our left. Not a huge range to travel based on this prior lower high, but it's certainly enough for a day trade scalp in the upward direction. What else do we know about the risk off rotation sector-wise? There's a reason why I chose J&J as the first one, and you'll see the next one in just a moment. They make sense structurally and sector-wise, right? So 3-bar play, hold to the 200 SMA, XLP is outperforming, looking for this over here. Even if you wanted to group this in and clump it in with the XLV, I actually don't remember which sector it falls into, so let me know down below in the comment section. Regardless, the setup is still the same. 3-bar play higher. We've mapped out the target. Let's get a little bit more granular on the hourly and make sure we have the levels proper. I would just argue that this wants to drop down to 50 cents, so 159.50 as your pullback low, and the breakout is actually going to be much closer to 161.25 for the sake of round numbers. And also, you never want to cherry pick the wick. There's a little hint for you. And then this target back from the left, we would be looking at 163, for the sake of, again, round numbers. You guys know the name of the game, 25 is what we'll round to on that one. So that is your trade higher. That is bullish. You are looking for consolidation here, and then you are looking for some way to participate in the upside with tight risk on the hourly, right? You don't just want to be long initially on the break. You want to have some kind of indication, okay, I'm going to put my stop here. I'm going to wait for the break. I'm going to wait for the higher low above, and then I'm going to put my stop just underneath, right? That's how you want to participate in that one, and we will continue along to the next idea. Invalidated, obviously, if we're underneath the inside bar low at 159.50. Next up is CVX for Chevron, and as we know, what are the outperformers this week? Of course, you're getting your XLE in the top dog of the list as well. Now, there are plenty of energy companies out there, but what makes this trade up so attractive? Let's firstly put in the breakout area at 153. This is all the groundwork I should have done ahead of the recording, but you're seeing it live here in real time. If this is going to be bull flag breakout, look left, we have thin structure. We have a gap that is closed mostly, and the first reaction was a pullback. It did not yield lower prices, even after breaking, to a lower low in this daily trend count over here. We're right back up at the equal highs. We know that energy is performing quite well as a sector. If we can move through this, looking left, we probably have some thin structure and targets to gather from that thin structure. The first place would be this. here, and the next place would be this up here. And these are all minor targets. These are not like big roadblocks, like a big weekly pivot. Maybe this one up here is actually closer at the 160.81. Your first, so maybe a little bit more clearance over 153.83. That's technically the level we just picked off from there. Opens the door for a stronger move for something that does this. A test of your 200 SMA is more likely if you can get that clearance of 153.83. So without further ado, that is going to do it for today's episode of the Midweek Market Update. I know this was a drawn-out one. If you appreciate the commentary, I'm looking at this through the lens of, like, you guys don't want to hear my thoughts in as much detail. You just want me to get straight to the point. And I imagine that's what most folks want to hear. But if you actually enjoyed the sort of thinking out loud about some of the charts, just let me know in the comment section, and maybe I'll think of this as being okay in the future. Regardless, I'm going to wrap it up here. If you enjoyed, let me know down below. Simple thumbs up goes a long way as well. We will be live tomorrow morning at 8:15 for our pre-market prep. Iffy on the Friday session due to travel out to Las Vegas. If you're in Vegas, send me a message over on Twitter or maybe over in the Discord. We'll see if maybe we can connect. And that would be a first, by the way. And we'll go from there. So appreciate y'all tuning in. Have a green trading week.